I'm going to help explain rate locks for you. Once you get under contract, we're going to upload you with the investor and we're going to lock you into your interest rate. More than likely, it's going to be a 30-year fixed or something along those lines. But what most people don't really realize is that interest rates fluctuate every day throughout the day. So think of the stock market. And when you see a graph on the stock market, how it goes up and it goes down, that's what rates do every day for us. So when we lock your loan for a period of time, we're locking into that day at that time, what was the interest rate for that day. Now, oftentimes we don't do this until you get under contract. The reason for that is because sometimes you write a really quick contract and we try to close you in 3 weeks or less, which actually happens a lot. Or other times you might write a 60-day contract where you're not closing for 2 months. And so at that point, we're going to lock you in for a period of time based on that day's interest rates. Now, you might have an option to float your interest rate. What that actually means is we're just kind of getting the process started. We're going to disclose to you without your interest rate actually being locked in. People have different reasons for choosing to do that. Oftentimes, somebody who is really watching the back end of the market and thinks that they have some insider information and they think rates are going to come down and they want to wait or take that risk, you can choose to. Most of the time, I recommend locking sooner rather than later because once your interest rate is locked, you're protected. If rates go up, you still have that lower rate. If rates go down, there are options that you can talk with us about. So it might be to your benefit, it might not, but just know that you can always come back and talk to us, but you're protected if rates go up so that your interest rate is locked in. Locks come in all different sizes in the sense that you can do a 15, a 30, a 45, a 60, a 90. All of those locks, though, the longer the lock, there's going to be a higher cost for that. So just know if you're negotiating with a seller a 30 versus a 60-day close, maybe because they want a post-occupancy or something along those lines, know that a longer lock is going to have a higher cost. For instance, maybe a 30-day lock has a 6% interest rate with no cost. A 60-day lock might be a 6.125% with no cost, but you could always pay the difference to get back down to that 6% too. So it's a lot of information. Know that the conversation is always open whenever it comes time to lock, so that way you have all of the information for your options when locking your loan.